Well, I thank you guys all for being here this morning on President's Day. We are supposed to celebrate our presidents. Not sure how, but we're going to celebrate presidents. Yay. Okay, we're done celebrating. Now let's get back to work. So let's jump into kind of what happened this week, because last week was, I told you guys it was going to be volatile. It's going to be crazy. And it was completely different. The expectations that everyone had for lower inflation, it was completely the opposite. So I'm going to break that down. But here's where we ended up this week. And excuse me. Let me just jump in here. So the headline inflation. So January CPI forecast, this is what everyone was forecasting. So currently the headline was at 3.35. The core was at 3.9. Everyone's projections were, if you were to replace last January's high number of I think it was 3.9 and change with a new one, you would bring that down and we would get a projection of a market forecast of 2.96 was going to be the new CPI. So expected 2.9. What did we get? Well, we didn't get 2.9. We got 3.1. So it was hotter than expected, and that kind of blew everyone out of the water. So anytime, even if it's a low number comparatively, anytime it's higher than what the markets expect, we get a shock to the market. The Dow dropped 2%. We kind of talked about what would happen there. The mortgage bonds, the bond market hated it, and we got a sell-off, and rates spiked. So if you look at the month-over-month differences, the headline was up 0.3. So for the year, that means annualized, you multiply that by 12, that is an inflation reading of 3.6. Okay, so the Feds want a inflation reading to be at 2.0. So we're hotter than we want to be. That's where we're at. But let's look to see what the problem was, what the culprit was. So shelter was up 0.6, which is hot. That's really hot. That's a 6.6% for the year if we kept that rate. That's really hot. So shelter lodging away was up 1.8. That's ridiculously high. That is equivalent to, well, like 19.6% inflation for the year. That's not sustainable. So there's something going wrong here. And I'll tell you what that was. Did you know the way that they track this is they do a survey and they ask people, how much do you think you'd rent your property for if you were to rent it? That's the data they use. It's not even actual data. It's, I think, or I project I would rent it for this. And they do surveys, and that's where they get that number. Now it's only 1.5% of the core, but still, that was pretty hot. And then motor vehicle insurance, look at that. We are up 1.4% month over month. Year over year, that's 20.6 for insurance. Like, what is happening there? Are people just driving drunk and knocking into, I don't know what the story is here, but that's a ridiculously high
I've
number.
never had an accident and mine's way up. I couldn't believe it.
You're going to pay for it, but we're paying for it, right?
I predict it's those billboards you see.
Yeah, maybe. But yeah, unbelievable.
I think it's people texting and driving.
Yeah, maybe. Whatever it is, we are paying for it, and that's a big number. Medical care services is up. That's like 8.4% year over year. Used cars, that's coming down. So as the chips manufacturers kind of catch up, and as the overall trade with vehicles over, like back and forth from Asia and wherever our cars are manufactured gets better, more cars are available. And what does that do? The more supply, the less demand, prices come down. And which is the opposite of what we have with real estate right now. We have less supply and high demand, or moderate demand. And then energy, we lost a little in energy, but all of this came as a surprise to us. We had a lot more inflation than people expected. So here we are, we're at 0.3 month over month. core 0.5, and then the rest remaining. So PPI was strong as well. So at the beginning of the week was CPI, that's the consumer product index. And then we have the producer price index, I'm sorry, which is the actual production and what it costs to produce. That was high as well. So we got a double whammy last week, an absolute double whammy, which is not fun for mortgages. And I'll show you what happened to interest rates. So inflation means a hotter economy, right? It just means that people are spending, they're willing to pay more, and they're kind of pushing this economy to be stronger. And the feds don't want that. The feds want it to be weaker. Well, these numbers go against what the Fed's thinking. And now it's got the feds really second guessing what they want to do. In other words, we thought maybe March they'd cut rates. Then we thought May. Now we're thinking they're not going to start cutting till June, which I predicted March Madness. That's getting kicked down the road. And we wonder, well, what happened? What made this extra spending happen and people are willing to pay extra? And what's driving this inflation outside of the insurance and people texting, right? What about the consumer spending, like the cost of goods? Well, if you didn't see this, and you'll be shocked to hear this, there's a certain state that I was from, it's named California, that is debating on whether to make the minimum wage $50 an hour. Now, if you're in economics and you say, okay, now you're working fast food, you're making $50 an hour, and then the hospital person, the nurse on the ER is making $50 an hour, there's some things we need to talk about. That shouldn't happen, right? But when you do that, that person at the nurse is going to be ticked, so she'll have to get her wages increased, and then everything else just goes skyrocket. A burger goes from $15 to $30. That's how inflation happens. It starts with wages. So we need to be careful that we're not putting too much wage inflation into this market. And that's the type of thing that can fuel it from the back end, can fuel inflation, because let's just face it, when you run a company, you have a certain budget and any cost gets passed on to the consumer. It just does. That's just how business works. Every business is the same. So those are the kind of things I'm really watching and the Fed's watching that too, to decide on what they need to do to when they start cutting rates. So here's another thing that I don't know if you guys have seen, but this is called the buy now, pay later credit. So if you go into any shopping center now, or not any, most, let's see, Walmart's doing it. You can now get an installment loan right when you're checking out for up to, I think it's 12 to 18 months. It's something like that, to buy groceries and buy anything else. So you can just apply for an installment loan to cover it. And then you've got a certain amount of months to pay that. It's not a revolving credit line. It's just buy now, pay later. It's just another quick way of buying something without actually needing money. Well, look at this. That program in 2023, basically, this is their stock, by the way. It went from like $10 a share to $50 a share pretty quickly. 88 million adults, or 34% of adults, used this program in 2023. And we saw a rapid increase. Look at the rapid increase in use during the holidays. People said, you know what, I don't have the money, but I want to buy it. And their stock went through the roof because everyone was using it this holiday season. And you might question, well, okay, how does that affect the numbers that the Fed's looking at? If people don't have money, but they have availability to credit, they'll use it. And that's what the US economy is driven. So the availability of credit is what the Feds have been trying to stop. They want to make it expensive to slow down the markets. So they've been raising rates so people don't finance anything. Well, then here comes buy now, pay later. And they just blew that out of the water and basically said, no, please keep buying. And they made it too easy. They made it super simple. And now all of those are being used. Now look at this stat. 33% of them so far have missed one or more payments in the last year. So that's a third of all of these buy now, pay laters have missed a payment. So not a good thing, but if we wonder why the economy looks hotter than it is, why the spending is considering it keep on increasing, this is one of the pieces that's doing it. So we need to really watch this, because are we kicking this can down the road? Is the economy really doing well? Or are we just finding alternative ways to spend money we don't have? And will that catch up to us? That's what I'm going to really, really watch carefully. So what did all this do to mortgage rates? What did this higher inflation, the higher CPI, the higher PPI, what did that do for interest rates? Well, here's the chart. And this is the chart over the last couple weeks. So we had a really good day back here in late January. We kind of spiked on the 30-year bond. And this is where rates were the lowest they've been in a long, long time. And we got into the nice mid to high sixes here with no points. And then we just saw a drop off. And this big candlestick right here, where the mortgage-backed securities lost a lot of value, that was the CPI. That was the first number in inflation. Look how the markets react. It just dropped off the floor, but look where it landed. It stopped right on this Fibonacci level. So that's a good thing. We have a little bit of resistance there. And then the last couple of days, there was a little bit of a rebound. It got a little bit better. And then the final inflation report, the PPI, that came out. And again, we dropped all the way down to this. This is the 100-day moving average. And then this Fibonacci level bounced right off it. So we're secure. We've got a good, solid foundation here. I don't think we'll drop any further. So we should rebound higher, but it's going to take a lot, because we've got this trend, this downward trend, and we've got a lot of room up here to push through. But I think we're going to, if on the heels of some good news, bond-friendly news, we may push back up and gain a little ground this week. So I'm hoping that we'll start to see the numbers on the retail and some other things come out that really show a true picture of what the economy is going through. And then we should see a rebound. Because there may be something out from left field that gets us again. So that's where we are with the 30-year. So we lost quite a bit. I mean, this is from 1.7 to, so we lost a rate 2 weeks ago that didn't cost anything. There was no points. That same rate now costs 1.7 points in discount points to get. That's how much we lost. And that's a big difference in rate. If you increase the rate to absorb that, it's probably a half in rate difference of where we're at. So not a good week or 2 weeks, but that's where we are. Here's the 10-year. And remember, mortgage rates go up with the 10-year. So a 10-year, look at that trajectory. It just kept high. It just kept rising. And then mortgage rates rose with it. But we bounced off this. Looks like this was the 150-day moving average. We bounced off that and came back down. So hopefully we'll come back down and remove this trend and go the opposite way. So where are our rates? If you are 30% down with great credit, now these are not my rates. These are the average rates for the nation. If you look at 30% down, 800 credit score, those are the rates right now with no points. Now you can get a lower rate. We can always talk about buy downs, but that's with good credit, 800 plus, 30% down, primary residence, checking all the boxes. That's where we're at. Here's with 5% down with average credit. Not so pretty. So not a very fun thing to look at, but that's kind of where we're at as an average. Now, I think our rates are actually better than this. But I just want to give you what the national average is, because when you do this, I don't have to do APR and talk about fees, and there's some legalities there. So this is the average. So that's where we are with rates. Hopefully we'll get some rebounds. I'm not going to go over this week because there's not really a lot going on that's too impactful. But let's look at, remember I'm telling you guys I'm going to do a little bit of free things, real estate hacks. Here's a real estate hack that I want you guys to all really think of every time you're working with a buyer. Okay. Waiving contingencies. That's going to be more important as more and more buyers come back into this market and as inventory keeps shrinking. Waiving contingencies. I want you to know that if you are putting 20% down or more, if your customer is, and you want to waive the appraisal contingency, we can do it with confidence. My system allows me to go into Fannie Mae and Freddie Mac and see if we can get an appraisal waiver on that property that you're making the offer on before you make the offer. So if you're doing 20% down, you want to make it as strong as you possibly can, give me the address, I'll run it through the system, I'll see if that property has an appraisal waiver attached to it. Then we can make that offer knowing that we don't need an appraisal at all. We can waive the appraisal contingency and move forward with a stronger offer. That's one hack. The second one is waiving the financing contingency. If your contract, if your purchase is contingent on the financing going through for that buyer, we can waive that by getting that loan pre-approved all the way through underwriting with a guarantee to the seller that's dollar-based. We can get that loan fully approved up front. So the only thing we need is an appraisal, which if we have a waiver, we don't need that, and the clear prelim and a contract. Obviously, you need an executed contract. And that way you can waive the financing contingency, you can waive the appraisal contingency, and you can close in 2 weeks, 10 days, whatever you want. So we need to get really, really good with understanding how we can position our buyers to have the strongest offer. And these two things will really, really help. So again, to do the waiving of the appraisal, you need 20% down minimum. Keep that in mind. FHA, you can't get it with 3.5%, 3% down first-time home buyers. They can't get the appraisal contingency. However, they can do the waiving of the financing contingency. All that takes is us getting everything in ahead of time and submitting that into the underwriting to get it fully approved up front. So these two things will absolutely change your offer strength. And we need to make sure we're coaching our borrowers, because lately, guys, I've seen contracts come to me saying, I need you to get a pre-approval, we're under contract. And I'm like, oh my gosh, that's not how you should do business. I understand buyers sometimes make the rules. They're like, you know what, I'm already pre-qualified through Chase. Let's just make the offer and see what happens. And then they get it. And they're like, oh my gosh, I can't get a hold of my person to update the pre-qualification or do whatever. And then they call upon me to do that on the weekend. I'm happy to do it. I always do it on weekends. Weekends are always very busy for me, but it doesn't put us in the best position to make sure we're setting it up for success. So getting that done ahead of time, making sure we talk to go over all of the strategies to get the best rate possible, so that when you're making the offers, you know about the 3-2-1 buy down, 2-1 buy downs, permanent buy downs, what that looks like, how much that can increase the potential purchase price for having the same payment by doing a rate buy down. All of those things, we need to have that conversation with the buyers up front before they start shopping to really get them ready to get the best deal possible from both sides, from your negotiation and from the rate options and mortgage options we have available. So waiving contingencies, that's going to be super important. Now, what next? How come? There we go. So my weekly real estate tools that I want to share with you, this is the cost of waiting. Now, you can email this to your borrowers. This is a representation of somebody saying, you know what, Sean, I'm going to wait for rates to come down. Or, you know what, Sean, I'm going to wait for more properties to be on the market because there's nothing to choose from. Those arguments we hear of people just waiting. This cost of waiting will take into account, okay, rates are high. Let's just say they change. And let's say they come down in the near future. Great. Were you better off? And if you wait 1 year versus you wait 2 years versus 3 years, this shows how much they're going to lose in the red here, how much they're going to lose by waiting. It takes into consideration how much they're going to lose on appreciation, amortization, because once they buy the home, they start paying their mortgage down and creating equity. That takes everything into consideration. So this is based on very, I would say, conservative numbers, and it takes everything into consideration. So if you have people on the fence, if you want this sent over to me, or want me to send this over to you for them, let me know, because this is a fantastic way to really open their eyes to what they're losing by waiting. And again, this is not rates are going up. This is rates are going down, and it's still better. Okay, now my real estate tip for marketing. Divorce. We all know people that go through divorce. What happens typically? We have a separation, we have real estate that needs to be sold, or one person is going to buy the other person out, whatever happens, there's a movement from one household to two households, and that's where your services are needed. So how do you market to really focus on getting a good stream of referrals from divorce attorneys? Like, how do you do it? Do you look in the phone book? Like, what's the easiest, simplest way of doing it? And I'm going to share something with you right now that I really, really like. And hold on, I'm going to do this real fast. I'm going to pull this over. This is good old LinkedIn. Now, I don't know if you guys like LinkedIn or not. I hate LinkedIn because of all the notifications I get. I mean, it's just unbelievable how many notifications I get. But it is a fantastic tool for looking up very specific people. So I talk about this in some of my business planning sessions. You want pillars of your business. Think of your roof, the ceiling, as your business. You want different pillars holding that business up at all times, whether it's first-time home buyers, your sphere of influence, divorce attorneys, financial planners, whatever it may be. You want different streams of referrals coming in from different aspects, whether it's your farming team, farming area, whatever it is, right? To hold your business up. The more pillars we have, the more lucrative our business will be. This divorce attorney pillar can be built this way. Go into LinkedIn, type in divorce attorney. You can do it by city. You can do it by state. You can do, I'm going to just say Arizona, or let's just say Scottsdale, since that's where my Phoenix office or my Maricopa County office is out of. And here you have a whole group of divorce attorneys. And you can go into, you can connect, you can create a pre-scripted little message, and you can put it in here. Do you want to send with a note? Go ahead and send it with a note. And where'd it go? It pop up went away. Anyhow, so that's pending. I must have said no without a note. Connect, add a note, type in your note. Say, you know what, I'm a real estate agent in the area. I'm looking for some great divorce attorneys in your area. You come highly recommended through social media. I would love to set up a time to connect with you to see if you have a preferred agent that you are referring business to when the need arises. Something like that, right? Send that off. And then once you do that, I would say do it to 100. Like, just do it to a whole bunch of them. Like, the more the merrier. It's a numbers guy. It's a numbers game, guys. Just connect with all of these divorce attorneys, family law. I mean, go through all of them, connect. And then once you have these contacts, then you go to this screen. These are your contacts. So let me just go here to me, my network, go to contacts. Now look at this fun little thing right here. It says export contacts. Once you have all of these people pinpointed by what they do for a living, you just click export contacts, and then this nice little pop-up comes up and it says, would you like to export everything? And you say, absolutely. Download everything, contacts, account history, everything, right? And then you hit request archive. Then in 24 hours, an entire spreadsheet of everyone that you've connected with in LinkedIn by what they do, their telephone numbers, their email addresses, and everything gets sent to you. It's magic. Then you go through that and you put them into your monthly drip campaign, your dial-up campaign. You start calling them. You've already sent a message, so you give them a call and say, you know, I connected with you through LinkedIn. Thought I'd just give you a call as well. And you try to build those relationships for divorce attorneys. You can do this with anything, guys. Financial planners. I mean, everything. Whatever you can find in LinkedIn by searching here. You can do wedding planners. Wedding planner, Scottsdale. See all people results. Boom. There's one. There's interior. Here's one right here. Wedding and event planner. And you can call them, say, hey, you work with people that are getting married every time. Do you have anyone to refer them to an agent if they're looking to buy a house? There you go, guys. There's your tip of the day for LinkedIn. And again, I'm not a huge fan of LinkedIn, but there's some really, really fantastic tools that we can use in LinkedIn to really, really bolster our business. So any questions on LinkedIn and what we can, how we can use LinkedIn in our business? All right, well, I think all of you are probably going to tinker a little bit with LinkedIn today. I hope you do, because it's a great way of building your business and your pillars. So if you guys need anything, let me know. I'm always here to help. I'm going to stay on the call for just a little bit longer. And if you need anything, I'm here for you, and enjoy your week. And again, if you have any questions, now's the time to ask. We're in a Q&A session officially.
So Sean, I've heard about when the availability of credit loosens, that typically that the when it loosens so much, that's when a downturn, a recession or depression happens, because people take advantage of that credit and then default. I don't know what
it could, and that's the let's look at an example. So if we have credit that's easy, like really easy to get, not easy to get, but looser credit or cheaper credit, people will take advantage of that because it's cheap. If it's easier, they'll take advantage of that because it's easier. But if it's really expensive and hard, that'll restrict it. Right now, what the feds are trying to do is make it expensive and hard to get. So the feds right now are making it a little bit more expensive and harder to get so that not as many people can go buy things. To stimulate an economy, you make it easier and cheaper, and then people will go out there and get it. But if it's easier, it's cheaper. Easier doesn't necessarily mean they can't afford it. Sometimes it does. But in today's standards with the Dodd-Frank Act and how people are used, how people are now looked at when qualifying, the standards of getting that approval are much stricter than they used to be. When the feds say we're going to be more restrictive, they're raising interest rates. And when they do that, what happens is the major players, like the corporations, they don't go out and grow as much by financing their growth. They slow their growth down, and that slows the amount of inventory, which slows purchasing, which kind of trickles down to the overall growth of the economy. So when they're talking, they're not really talking about the individual consumer. They're talking on more of a macro level with the big giants out there that, let's just say Walmart, if they could borrow money against the feds for 0%, they're going to open up 5 more Walmarts. Why not, right? It doesn't cost me any money to do so. It's borrowed money. It's not my own. It's a lot more cheap. So they'll grow. If that's now 7% or 8%, now they're going to be like, ooh, I'm not doing that right now. And that's what slows down the economy. Now, for you and me on the streets, if let's just say I'm in an area and I want to buy a car and I can only afford $350 a month. Right now, a car at 7 to 8%, your payments, I mean, the average payment right now is like $800 a month for cars because of that. That's restrictive. You're probably not going to buy a car. So higher rates are restrictive. So that's kind of how that works. Now, what you're saying is, yes, can you get into trouble and get too much debt when it's cheap? Yes, you can, but it's still cheaper, and that's more people will do it, so that fuels the economy. That defaults, yes, that can hurt the economy, but when money's cheap, the defaults actually are less. It's when they start spiking back up. Like this is what happened with credit cards. It was really, really cheap. And then people started racking up their credit cards, and now it's more, and now their minimum payments went from $150 to $350 a month because the credit cards, the interest is going up. So that slows people down, but then it also increases defaults. So that's what we're seeing right now. We're seeing a higher amount of defaults on credit cards now than we did a year or two ago. So there's a little economics 101 from that standpoint, but you are correct. It'll fuel that, which could lead to more defaults, but the opposite is true as well. So where they meet in the middle is kind of where we're at right now, because it's growing, but then there's defaults. And then the more defaults there are, that's where recessions happen, because the whole markets start to slow down. I hope that wasn't too long-winded. Perfect. Thank you, guys. Any other questions? Make sure you unmute yourself if you have some questions.
Sean, can you explain? I'm just learning all of this now. You know, it's like so much is over my head still. But when you said in the beginning that the government wants it soft or wants it slow.
Yes.
Why?
So the government wants to keep the prices of things down. If and slow the market. Kind of think about it as like a car's motor, and what the feds want to control is the gas pedal. If you're running your gas pedal, flooring it the whole time, the engine will overheat. That's kind of how the economy is. They want it to be like the Goldilocks. You want it to be push it down enough to where there's stability in the markets, not where it's crazy. Like let's look at cars for an example. During COVID, we saw the prices of cars go absolutely bonkers. Like it was crazy. There's a lot of money and there was very little availability. So people thought, well, I have access to money easily because I'm getting, I don't have to pay for rent. I'm getting these monthly paychecks. So they went out and they bought, but there wasn't a lot of cars. So what happened? The prices kept going higher and higher and higher. So the feds want to slow the roll. Okay, pull back that money supply so not everyone's trying to buy things at the same time, which causes inflation. If everyone's trying to buy one item, the price of that item will go up just because of demand. So they want to slow the demand down, slow everything down to make sure that price stability, which is one of their number one goals, is constant. So when I say that they're trying to slow things down, they're trying to go from the gas pedal being floored to kind of somewhere in the middle. That's what they're trying to get. So they want a 2% inflation rate. But what people don't understand too is that the cost of goods is never going to come down. We're stuck where everything is right now. The feds just want the rate of inflation to slow down. So instead of increasing at 6% every year moving forward, it's only increasing at 2%. And that's their goal. So if people think prices are going to come down because inflation's coming down, not true. The rate at which things are going to continue to increase is what they want to slow down. But the price of bread, we're stuck. Unless we're in a deflationary environment, which is a completely different environment, where the cost of goods is so low because nobody's buying anything, or because manufacturers figure out how to produce it better. And here's an example. In the 80s, a microwave oven was $1,000. They figured out how to make it cheaper and more cost effective, so prices went down. So as manufacturing grows and efficiency grows, their prices can come down as well. But if people aren't buying and manufacturing gets cheaper, that's how we see deflationary markets where things actually come down in price. But we're nowhere near that right now. It'd be nice if we did have that a little bit, but we're nowhere near that right now.
Okay.
Again, that was a long-winded answer, but I just want to make sure you guys kind of understand the pieces of that. Any other questions? All right, guys. Well, enjoy your week. Enjoy your President's Day. Go do a parade or jumping up and down and do fireworks. I don't know what we do for President's Day, but whatever we're supposed to do, go do it. Have fun. Sell some homes, and I'll be here for you if you need anything mortgage related.
Thank you, Sean.
You got it, guys. Have a great week.
Thank you.
You're very welcome.
Bye, guys. Bye, Carla.
Bye.
See you guys.